In this video, you'll learn how accountants record sales and sales tax for a merchandising business. And to learn all about the accounting practices of merchandising businesses, we will focus on Max Out Sporting Goods, which sells the latest sporting goods and sportswear for men, women, and children. It is a retail business, and Max Ferrero is the sole proprietor of the firm. First, merchandising businesses require a different chart of accounts than a service business because merchandising businesses sell products, not services, and our accounting practices will be different as well. In addition, a retail business requires an inventory system to account for merchandise inventory that is purchased, that has been sold, and that is on hand at any time during the accounting cycle. Max Out Sporting Goods buys products from its suppliers and posts its available for sale inventory in an account called merchandise inventory. We will also be studying the two inventory systems used by retail businesses, the perpetual and the periodic inventory system. Under the periodic system, the cost of inventory on hand must be determined by counting merchandise inventory in stock. That is why it's called periodic inventory system, because the business periodically counts what it has in inventory. The inventory could be done yearly, quarterly, monthly, weekly, or based on another frequency. That is one of the disadvantages of the periodic inventory systems. You need to count your inventory to know how many items you have in stock. For the perpetual inventory system, on the other hand, the business keeps track of the inventory with every purchase and sale and knows how much it should have in its inventory based on those records. Such a system is more expensive because you need specific systems and processes. That is why larger businesses typically use it. These businesses still have to count their inventory, but typically only perform what is called a cycle count, meaning you're just double checking the accuracy of your system and you're checking for loss and fraud. After all, the system wouldn't know what inventory was broken, stolen, or for some reason is obsolete. So these businesses still need to count. Cycle counts count a certain percentage of products each period. For instance, you count 9% of the products in January and 9% of the products in February and 9% in March, so that you effectively cycle count through your entire inventory during the year. What else is different for a merchandising business compared to a service business? I briefly mentioned that we need a different chart of accounts, and there are 5 new accounts that we will be using to record merchandising sales transactions. There are sales, sales tax payable, sales discounts, sales returns and allowances, and credit card expense. The sales account is the primary revenue account for a merchandising company. This account is a revenue account and has a normal credit balance. Merchandising businesses also are required to collect sales tax for the state tax agency, and the business records that amount as a liability on the balance sheet until the sales tax return is prepared and the liability is paid. The sales tax payable account has a normal credit balance. The merchandising business also uses the sales discount for early payment discounts and the sales returns and allowances accounts when the customer returns merchandise or receives a credit for damaged goods. These accounts are contra revenue accounts with a normal debit balance. We'll also use the credit card expense account when the merchandising businesses process credit card payments from customers and is charged a fee by the credit card processing company. Let's practice these new transactions together. In our first transaction, Max Out Sporting Goods sells merchandise for cash. Just like we've done in the past, we start by analyzing the transaction, what accounts increased and what accounts decreased. In this transaction, Max Out has more cash. So cash increased. Cash is an asset, and according to the dealer mnemonic, when assets increase, we debit them. The second part of our transaction is that the sale of merchandise increased. These type of sales are revenue, and revenue increases with credits. So debit cash and credit sales. We record the sale of $500 for cash by first writing the date in the date column and then cash into the description column and $500 into the debit column. On the next line, we slightly indent and write sales into the description column and $500 in the credit column. Let's look at the next transaction. Max Out Sporting Goods also grants credit terms to certain customers. On January 3rd, Max Out Sporting Goods sold merchandise on credit to Roy Anderson, issuing sales slip 1101 for $400. Two things happened here. Monies owed by customers increased. We call that accounts receivable. Also, sales of merchandise increased as well. Accounts receivable are assets and sales of merchandise is revenue. Assets increase with debits and revenue increases with credits. So accounts receivable debit and sales credit. We record this transaction by first writing the date into the date column, then accounts receivable into the description column and $400 in the debit column. On the next line, we slightly indent and write sales into the description column and $400 into the credit column. In the third transaction, the credit customer, Roy Anderson, pays Max Out Sporting Goods on January 31st for the merchandise bought on January 3rd. In this transaction, accounts receivable decrease and cash increases. Accounts receivable is an asset, and assets decrease with credits. Cash is also an asset, and it increases with debits. So we record the transaction to increase cash by first writing the date into the date column, and then cash into the description column and $400 into the debit column. On the next line, we slightly indent and write accounts receivable into the description column and $400 into the credit column. Most state and many local governments impose a sales tax on the sale of certain goods and services. Businesses are required to collect this tax from their customers and pay it to the tax agency. There are special rules around what is called sales tax nexus, the requirement of a business to collect sales tax in a state. Some states, sales are exempt, whereas in other cases, the purchaser has a sales tax exempt certificate. In other cases, sales across state lines are only taxable if they exceed a certain dollar amount. You can probably already guess that this is a complex topic, and some accountants only focus on sales tax, determining sales tax nexus, filing applications, and filing sales tax returns. In general, though, when taxable goods and services are sold on cash or credit, the sales tax is recorded at the time of sale, even though it will be collected from the customer later in the case of a credit sale. A liability account called sales tax payable is credited for the sales tax charged. Let's look at this transaction where Max Out Sporting Goods was required to charge its customers an 8% sales tax. The amount collected for the sales tax on a $500 sale for cash is $40, which is calculated by multiplying 500 times 8%. We're now dealing with a transaction that includes more than two parts. First, cash increased. Cash is an asset, and assets increase with debits. So we need to debit cash for a total amount collected from the customer, which is $540. Then the merchandise sales increased, and those sales are considered revenue, and revenue increases with credits. The amount of the sale is $500. Last, sales tax owed increased because MaxOut must pay the sales tax to the tax agency. Sales tax owed is a liability, and liabilities increase with credits. The amount is $40. The next transaction is very similar, but instead of collecting the cash immediately from the customer, in this case, the customer purchased merchandise on credit for $600 plus sales tax. So let's analyze this transaction. First, accounts receivable increase, and accounts receivable are assets, and assets increase with debits. So we need to debit accounts receivable for the total amount billed to the customer, which is $648. Next, the merchandise sales increased, and those sales are considered revenue, and revenue increases with credits. The amount of the sale is $600. Last, sales tax owed increased because MaxOut must pay the sales tax to the tax agency. Sales tax owed is a liability, and liabilities increase with credits. The amount is $48. Sales tax can be quite complicated, and I have found it helpful in the past to use services such as Avalara that helps with identifying nexus and filing the sales tax returns. In addition, Avalara can link directly into your accounting system so that, for instance, the sales team can give accurate quotes, including sales tax, right away. In closing, let's also briefly talk about the audit trail and proper documentation for all sales transactions. All sales transactions must follow good control processes. Only authorized individuals should be able to issue quotes, invoices, and return authorizations. In addition, auditors will want to test that these controls work properly and that salespeople do not give unauthorized discounts to customers. Also, auditors will want to tie out the total sales on the income statement to the sales invoice register. So it's very important for the accountant and the accounting team to have a good handle on all sales transactions. I hope you found this video informative and gained a good understanding how sales and sales tax are recorded for cash and credit customers.